Welcome to the Microcap Brief. A reverse stock split can be the last gasp of a dying company or the starting gun for a massive recovery. How do you tell the difference? Today, we go beyond the theory and put two real companies under the microscope. First, a critical disclaimer. The companies discussed in this video are used as historical case studies for educational purposes only. This is not a recommendation to buy or sell any security. We are analyzing corporate actions from the past to learn a lesson for the future. Past performance is never a guarantee of future results. Let's start with the trap. Our case study is Helios and Matheson Analytics, HMNY, the parent company of the infamous MoviePass. As we've detailed before, MoviePass had a fatal business model. By mid-2018, the company was burning cash, the stock had collapsed, and they were facing delisting. In July 2018, HMNY executed a desperate 1-for-250 reverse stock split. But this wasn't an isolated event. It was the company's third reverse split, a clear sign of a chronic inability to create value. The result was predictable. The stock collapsed again within months. It was a classic trap. Now, let's contrast that with a strategic masterclass. Booking Holdings, the company formerly known as Priceline.com. After the dot-com bubble burst, Priceline stock had collapsed. On June 16, 2003, they also executed a reverse stock split, a 1-for-6 move. On the surface, it looks like the same story as MoviePass, but the context is everything. Here is the critical fact. Priceline's turnaround happened before the split. In May of 2003, over a month before the split, Priceline announced its first profitable quarter ever. The stock had already rallied more than 300% off its lows. They were no longer in immediate danger of delisting. So why did a profitable, recovering company do a reverse split? This wasn't a defensive act of survival. It was an offensive move for growth. First, it was about perception and positioning. By elevating their share price to a more respectable level, Priceline was signaling to Wall Street that the turnaround was real and that they were a stable blue-chip survivor of the dot-com crash. It was a move to command respect. Second, and more importantly, it was about operational flexibility. A higher stock price provided a stronger currency for the strategic acquisitions that would define their future. This was a forward-looking move to equip Priceline for its global expansion, which they executed by acquiring key assets like Booking.com. The reverse split wasn't a reaction to failure. It was a proactive tool used by a strong company to get even stronger. It allowed a visionary management team to build a financial structure worthy of their ambitious plans to conquer the online travel industry. The result is history. The split provided a stable platform from which Priceline executed one of the greatest business expansions ever. So, what's the litmus test? When you see a reverse stock split, ask these questions. Is the business already profitable or showing clear fundamental improvement? For MoviePass, the answer was a hard no. For Priceline, it was a clear yes. The turnaround must come before the split. Is this a recurring event or a one-time strategic move? MoviePass had a chronic history of reverse splits, signaling a broken business. For Priceline, it was a single forward-looking action. Is the goal simply to survive, or is it to enable future growth? MoviePass was just trying to stay on NASDAQ. Priceline was building a stronger foundation for future acquisitions. Your key takeaway is this: never judge a reverse stock split by the action alone. Dig deeper. Is it a cosmetic fix for a failing business or a strategic tool used by a strong one to build for the future? The answer to that question can be the difference between avoiding a trap and finding the next global leader. Thank you for listening to the Microcap Brief. Do your own research and invest wisely.